All right, everybody, welcome to the Cash Flow Empire every Tuesday night, where we love to bring professionals, family, friends, experienced operators every Tuesday to talk about real estate, multifamily specifically is what we like to target. And what we like to take pride in here at the Cash Flow Empire is just talking about the dirty, ugly truth, right? And what happens behind these closed doors. And tonight, I mean, typically what we do is we always say, hey, we're not real estate, attorneys, we're not CPAs, please consult with them. But in tonight's case, we actually have Brent, who's a CPA himself. So I don't have to say that disclaimer tonight. So that's pretty cool. That being said, I mean, Brent, welcome to our call, and thank you so much for coming. If you'd like to introduce yourself.
Yeah, happy to. So Brent Bement, I am a CPA, and I've been running the practice for 7 years. We've got 12 employees. I was actually employed. My dad started the CPA firm back in 1989. So I grew up, I was an 8-year-old kid wanting to be a CPA when I grew up. Like, what kind of 8-year-old wants to do that? But I really started to realize what it was when in high school and college. I'm like, all right, I think I'm liking this, but luckily I stuck with it, and it's been great. But I got into real estate investing really like in 2008. I started real estate investing, but 2018 is when I really started to jump into it. And that's when I started to I'll show you guys the recommended structure I have. I started to structure all my own finances like this. And I was honestly kind of a typical CPA for the first 10 years. But 2018, it just completely shifted when I started doing all this myself. I'm like, all right, it's go time. I'm sharing this with everybody I can, and we're going to grow as much as we can. And it's been a fun ride. From the real estate side of it, I spend probably 20% of my time on real estate deals, finding new deals, and multifamily and mobile home parks and commercial building. Kind of commercial, warehouse, and industrial are kind of my go-to type of investment right now, but I love multifamily as well. So just excited to be here and excited to share what I know with you guys.
That is amazing. No, thank you, Brent. And I want to start a conversation like this because I read some articles not a long time ago about the 100% bonus depreciation coming back. So do you think that you can elaborate a little bit more about that, because that got me excited right away? So.
Oh my gosh, yeah, I am so excited about that. So if all of you real estate investors, like I'm sure you've heard of 100% bonus depreciation. Like we love real estate for a few reasons, right? Like one of them is the cash flow. This is the cash flow kingdom, no, cash flow empire. And we love cash flow when we especially love it when it's tax free. And real estate is one of those things that can do that. And it really is depreciation that creates that tax-free cash flow. So let me share my screen, and I'll give you guys an update on the 100% bonus depreciation tax law that's in the House and the Senate right now. I think in the next week, they're going to have something finalized, and I cannot predict the future, but I am very confident that something will pass. So let me go share the screen here. All right, you should see some of my favorite mountains in the background there. Can you guys see it all right? How about a nod from somebody?
Yeah, we see the whiteboard. Yeah.
Okay, now you see the whiteboard. Sweet. Okay. All right. Let's do this. First off, so the bonus depreciation, because I know it's like we love depreciation in real estate, but why? And what does the 100% mean? What does the 80% mean? I'm going to break it down. I'm just going to draw a single family home. I know we're probably going to be talking about multifamily, but it all applies in the same way as far as the tax law goes. So for depreciation purposes, or like a piece of real estate is split into 3 main sections. So this top one is building. This middle one is land. This other one is, I'm going to call it other here, but this is the bonus depreciation eligible. So bonus depreciation eligible items. So if it's split in 3 ways, here's kind of a common breakdown, somewhat of a common breakdown. Building is usually about half the value. Now think of like roof, walls, foundation. That's building, like the bones of a building. Land, it's common that it's 20%. And down here, this other is 30%. So if you've had your tax return done in the past, or maybe if you've done it yourself, you might not have had this other section. That might have all been just lumped together under building. A lot of CPAs will just kind of lump it under building. And the reason that's bad is because it takes 27.5 years to write off that building section. And this on the land, there's no depreciation. And now that bottom one, we can take 100% of that. So as far as like dollars and cents, give you a rough example of how that works. So on like $1 million property, we would take that other bottom section, that's 30%. We would allocate $300,000 of assets to that area. And in 2022, we could take 100% of that. So let's say this is 2022 depreciation. So 2022, let's call it rates or whatever we want to call that. That was 80 or 100% of that $300,000 deduction. So if you were the 100% owner of that $1 million property that was acquired, you would get a $300,000 depreciation deduction. If you were, say, a 10% owner, I'm assuming we're going to be talking about some syndications, raising funds, GPs, LPs, having the ownership split. Whatever your ownership percentage of that deal is, you would get your portion of that deduction. So in this example, a $300,000 deduction for depreciation. If you own 10% of that, you're going to have a $30,000 deduction. So here's where it gets exciting. Well, in the last week with this change in the tax law, because something we didn't love is that this bonus depreciation was going to start tearing down. So look at this. I think this is going to have a huge impact on 2024 investments and the excitement for investors getting into deals with the deductions. Because in 2023 it was going to be 80%, which is bad. It's not as good as 100, but it's not horrible. But that 60% rate, I think was going to impact quite a few deals. Like investors were not going to be as excited about the deductions. But what is in the law right now, or what is in the process right now to become law, is that they're going to be changing these. Both of those are going to go back up to 100% retroactively to the beginning of 2023. And for 2024, the whole year, anything bought in 2024 is going to be back to 100%. This stuff up here is still 27.5 years, and there's still no depreciation on land. Like land, it's just, and this is raw land. If you put landscaping in, or you develop some land, add trees, fencing, like if you improve it, all those improvements to the land, they'll get lumped up. They'll get into this section here. But just that's what we mean. If we're talking about going back to the 100% bonus depreciation, I want you all to think of this, like that bottom section. And as a rough estimate, in your estimates, and if you guys are getting into deals this year, or if you're trying to estimate like depreciation for the past year, I would use roughly that 30% rate. Like right here, just say, okay, how much was the building that we bought? We get 30% of that as a deduction. It'll kind of help you estimate it. Like, because if a lot of times if you're part of a deal, like I'm an LP on a few deals, and sometimes I will reach out and say, hey, what's the depreciation for the year? Are you guys maximizing the cost segregation and the bonus depreciation? And sometimes the CPA or tax preparer might have estimates to get back to you. Sometimes they won't. And sometimes you'll kind of need to come up on your estimates, or come up with your estimates on your own. So are there any, before we jump into anything else, John or Sergio or anyone else, any questions on bonus depreciation or any other parts of the new law?
I have a quick question just to kind of simplify it, because there's a lot of syndicators in this room. There's a lot of investors in this room where, I would love to give an example of you doing, let's just say an LP, if you're a passive investor, and a passive investor, let's just say invests the minimum of $50,000, what that would look like for depreciation, let's just say in 2024. Okay,
let's do it. And I'm going to start building out this entity structure. So I have an entity structure that I recommend for everybody. We're going to jump into this one. So if you've seen any of my other videos, if they're on social media, or if you've seen the other stuff, I'm usually using the same shapes and the same colors to just help people remember exactly what they were. Let's do this. Actually, we'll keep it simple right now. We'll get into some of the other structuring stuff later. All right, so I'm drawing a little pumpkin right here. Just kidding. This is the start of the structure. Let's say we got, I know every GP and LP deal can be different, and the way you split profit and deductions, it can be different, but I'm just going to go estimate that. Let's say the GP owns 10% of this deal, the LPs own 90% of it. And I'm assuming it's not like a fund structure. It's going to be a syndicated deal for a specific property. And what we're going to do, we're going to put, this is going to be my little apartment building here. All right. So this right here, that green triangle is the LLC, and that's the LLC that owns the property. And that's the LLC. Its ownership is split 10% GPs and 90% LPs. So let's say, and actually for simplicity to not like break it down with all the other LPs, we're just going to say there's only one LP, and that LP puts in $50,000. And really the number is going to be the same, but we'll just keep it pretty simple here. So what happens here, the LP puts in 50,000, right? The GPs find the deal, they structure the deal, they're working with the banks, they go get the financing, and they go buy this building, and they use $50,000 of cash. And then what's the other part of that? They need to get a loan, right? And let's say it's a $200,000 loan. So $200,000 loan. So total purchase price, and this is important, going off a total purchase price, because we'll talk about how cash, the amount of cash you have, the amount of loan, that ratio does not impact the calculation for depreciation. So that's important here in a minute. So total purchase price is $250,000. That's the $250,000 purchase price. Okay, so now let's say you operate it through the end of the year, and you have net income of zero, just for keeping the math easy. $10,000 of income, $10,000 of expenses, net income of zero. So the LP or GPs, you might think initially like, okay, we're not going to have a loss because we broke even. But even with the break even of cash, we will have a loss. And remember how I broke down that property into three different segments? We had the building, land, and other. So there's the building, there's the land, and there's the other. I'm going to do this 30% ratio on the other. And these ratios I'm using are just rough estimates. We do a lot of cost segregations, and that's just a pretty common estimate. So if I pull up the old calculator, you go 250,000, multiply that by 30%. That's a $75,000 deduction. So we're going to go like this, $75,000 deduction. So now we go, okay, this business, this LLC right here, when we go to do the taxes, on paper, this is a paper loss, on paper, we have a $75,000 loss. And so what we have to do there, now we're going to go split that. And again, can be different with every operating agreement, how losses are allocated, but it's very common, or it's common that losses are just split based on ownership percentages. But that loss goes into that LLC, and the GP is going to get a K1, and the LP is going to get a K1 for a loss of, take $75,000, multiply it by 90% to that GP or the LP that put in 50 grand. This guy or gal there is going to get a loss of 67,500. And so that's how it's like, how did I just create a loss of $67,000 when I only put in 50,000 of cash? It is the loan. I told you that the loan doesn't change. It doesn't change the overall deduction, but it changes. Like this is like, I know you guys talk about leverage here. This is like the perfect or a good example of leverage. Like you leveraged your cash, got a loan, and you multiplied your deduction. Because think like if that LP went out and bought a piece of property on their own for $50,000 of cash, their deduction, you guys know what that would be? What would the deduction be for this other depreciation if you bought a piece of property for 50 grand?
It will be 17,700.
Yep. So it'd be 50,000 times 30%. 17,000 was close. It'd be like $15,000. So the loan is what multiplied that deduction by 4 or 5 times. So Sergio, what makes sense or what might not make sense in that example? I know sometimes I'm maybe too simple. Sometimes I might be too complex. I'd love to hear some feedback.
That was perfect, just because for one, we do have this recording, so a lot of people are going to be able to kind of have a really great understanding on how we're able to, take advantage or appreciate the art on how the depreciation works from investing in the multifamily. So I think this was perfect. So great explanation on a very,
Awesome.
very simple level.
Very cool. And if you think of like, what if the law does not pass, which if I was a betting man, I would bet that it is going to pass. But if it didn't pass for 2024, that same investment, instead of getting a $67,000 deduction, just to show you guys the math on this, you'd get the 75,000 would still be these other assets, but we can't write off 100% of that for 2024. It'd only be 60% of that. It'd be 45,000. And then we multiply that by 90% to get the LP their K1. It'd only be a $40,000 deduction instead of 68,000 or 67,500. So that's the beauty of this law, assuming they pass it. Okay, very cool.
Yeah, that was pretty cool. Joshi, do you have a question right there?
Well, first off, I just want to say thank you, because I'm horrible with numbers and I usually just pay my taxes and don't ask any question. And the way you broke it down, it's amazing. I was actually able to understand it. So thank you.
Awesome. You're welcome.
We have one of our guys in the chat, Jake. He asked a question. He says, does that mean you have to refile your previous tax returns then?
So yeah, like if you had not done the depreciation in the correct way, I assume, luckily, so if you own a property, so this is like this example, we're just assuming you bought one in 2024, or say you had bought one in 2023 and we're doing the calculations for the first time. Thankfully, like if you own a property already, and if you've been doing depreciation like the incorrect way or not the most tax advantaged way, there is a way to include it on your current year tax return. So in 2023, we can still do a cost segregation and we can catch up all that missed depreciation. So like if you're like, oh, dang it, I just missed out on a $75,000 deduction or $67,000 deduction in the current year, we can go back and say, okay, you had 3 years of depreciation. You've already taken some, but you could have taken a lot more. We're essentially taking that difference and we can bring it all into the current year. It's for people really wanting to know the details and digging into it, it's called a 481 adjustment. And the 481 adjustment, it's called the change of accounting method form. We file those and we can pull the missed depreciation into the current tax year. It's pretty sweet.
Awesome. Thank you so much. By the way, guys, I'm going to be dropping his contact information in the chat, so please be on the lookout for that. And then we just have another question, which is from Corey. He asks, the depreciation only goes against passive income streams, right? Question mark. And then continues to roll over year to over year.
Yes. Yep. Let's talk about that. That is a very common thing we have, actually. So passive income. We'll go passive income and losses. We'll talk about that. So if you have, so let's go put ourselves in this LP shoes right here. So that LP had $50,000 of cash, right? They put it into the deal. At the end of the year, they get a K1 that has a negative $67,000. So at first they're really excited. And they go to their CPA and their CPA says, you're a doctor, you make $100,000 on a W-2 and you have this loss on a K-1 and you spend all your time as a doctor on a W-2 and you have a K-1 showing almost a $70,000 loss, we can't use that loss to offset your W-2. So that's where this comes in. That 67,000 is a passive loss and the W-2 is earned income. And there, it's so weird. The tax law, the more you learn about it, the more you realize it's just weird. But they're in two different buckets. It's all on the same tax return, but we can't take that passive loss and offset your W-2 income. So now it's like, well, what can we do? So option one, Yoshi had mentioned it. We can choose to, like, if we don't restructure other things or have other opportunities, which I'll talk about in just a second. Worst case scenario, you take it as a passive loss, which by taking it, we're not actually offsetting your income yet. It just kind of gets buried in a tax form and it carries forward to future years until you can actually use it. And so I'm gonna talk about those specific scenarios where you can actually use it. So option one is just, I just mentioned, carry over the loss is that first option. Option two is to have, this is easier said than done, I know, but have passive income. So say Sergio, if you started a shoe company and if you're like, hey, Brent, do you want to be a part owner of my shoe company? You don't have to do anything. Just give me some money and I'll kick back some income to you down the road. I'm like, okay, sweet, I'll do it. So let's say I give you 10 grand and I'm a part owner of your shoe company. So I, as a part owner of a shoe company, I'm a passive investor. I'm not operating the day to day. I'd be considered passive in that. And if the first year Sergio he had startup costs and he's just getting going, say he lost $20,000. And if he lost $20,000, if I was a 50% owner, I would get a K1 for a $10,000, or I guess we need to create income. Sorry, Sergio, we're flipping that around. Sergio, you made $20,000. You made $20,000 of income. And now I have passive income on a K1, because that's really what I'm getting at. I need passive income on a K1 and a passive loss coming from the real estate. So in that example, I could offset all the income that Sergio's K1 gave me. The $10,000 is completely offset. And we use $10,000 of this. We're using $10,000 of that. And now what do I have carrying over the next year? I have $57,500. So if you are part owner of a profitable business kicking off passive income, that is an option. If you have that passive income, that can be offset with those passive losses. Okay, this one, if you sell the property, this is another option of getting around those passive, like the SAD LP that goes to the CPA and he says he can't use it. But if you sell the property in a future year, the year that you sell that property, you can release all those passive losses. Like they could be accumulating for years. The year you sell it, it just gets released. And then that year you can offset your W-2 income. So that's the third option. Fourth option, I don't have a specific set of numbers yet. I'm just going to keep coming up with ideas till I run out of ideas. So fourth option is, I know you guys have heard of this too, probably. Become a real estate professional. Have you guys covered that in the calls? Would you want me to briefly kind of talk about
Go ahead. Yeah, go ahead.
Okay, very cool. So if you are a real estate professional, you've got to pass two tests. And this is, well, you're not going to go sit down and pass a test in front of the IRS. It's just like two tests that the law shows that you need to pass. But it's a self-certification type of test. It's the honor code. It's the honor system. But if you have 750 hours in real estate related activities, I'll just say in real estate activities, and you have to pass both these tests.
Per year or accumulated?
What was that?
750 hours per year or accumulated? Brent,
Brent, you're muted.
That's weird. How did I get muted? Okay. So it's 750 hours a year. Did you hear that part? So it's not like an accumulation of all your hours every year, and it's a calendar year. Starts January 1st, ends December 31st. And that second part of the test is you need to have more work in real estate than, I'll just say, other job. Like if you have a full-time job, like, that doctor example, and the doctor works 2,000 hours a year, you would need 2,001 hours in real estate related activities in that calendar year. I've seen it happen. Like we've had some clients that have full-time jobs that have become real estate professionals. It's usually for like a year or two. It's usually not something they're able to do just year after year after year, unless they quit their job and do real estate full-time. That with these 750 hours, that would be like management. A lot of times it's like, if you're swinging the hammers, all that would count. If you're doing some of the work yourself, all that would count. If you're sitting down, here's one thing I want to point out. If you're sitting down reading a book about real estate, that's not going to count. It's got to be actively involved in deals, working with the banks, closing on the loans. If you're researching specific properties, crunching the numbers, working with property managers, like there's a lot of real estate activities, but just make sure you track those. It does not get submitted to the IRS, but you just track it in a log or in your calendar and just save that in your files in case it ever got questioned. In 20 years of doing this, we've never seen one get questioned, but I would hate for you to be the first person I know to have it questioned. Okay, so that's any questions about the real estate professional stuff as I come up with this fifth idea here?
Yes, so Renee asked, can you offset the passive loss against rental income?
Yes. And I'm glad you mentioned that. So I'll add that here, like the passive income includes, and this includes rental income from any of your other rental properties, whether you own it 100% yourself or it's syndicated, you're a part owner. Because some of these deals, like that first year, especially with bonus depreciation, you can get a big loss. But we want our deals to be profitable, right? You want to have cash flow. And so after a few years, a lot of times they stabilize and they have more cash flow than the depreciation can offset. So yes, with your other real estate would count as passive income, which can be offset with your losses on your new properties.
Now, would a meeting like this count towards those hours?
That is a good question. If like general education, I would say no. If you're working on a deal and you're like, this is what I needed for that deal, that's exactly what I need, and you're able to take that and apply it to your deal, then it would. Like if you're working on a deal, then I say it would count.
Okay, awesome. I'll take that as a yes.
So you're all working on deals. That's good. Like I think 2024 is going to be a great year. I think a lot of people are afraid to buy, as you've all seen. Like interest rates went up and prices didn't drop as fast as they wanted, and people, I think it kind of became uncool to buy real estate. Or you all remember 2020, 2021, 2022. It was just a frenzy of buying, and I think people got burned out of that. In 2024, the people that are like really digging into this and understanding it, and they're looking at the key metrics and looking at the cash flow and the long-term wealth creation, like probably all of you, if you're here on this call, like you're going to start seeing that real value. And it's nice. It's not a frenzy. Like we've got time to analyze deals and get into specific deals. I think it's a great time to be a real estate investor.
Love it. Hey, Brent, before you move to the next part, the number 5, how do you track, how are you able to track those hours, right? To be able to show the IRS just in case you get audited or something.
Yeah. If you have, so the things you're going to need, like in a log, you need the date. And so normally like an Excel, like in a spreadsheet, a Google sheet, a Google document, Excel spreadsheet, or even having a like a Google calendar, but having a specific type of calendar, like specifically for your real estate hours. At the end of the year, you can do an export. You can export everything you'd need. So you need the date that you worked. You need the hours. And then the type, I'll just say type of work, which would include if you're working on a specific deal or you're redoing flooring or bathroom, or you're working with a banker on something, like I would have the property on there too. Property, etc. But yeah, Excel or in a Google Calendar is where I track it.
Brent, a question on that. So for example, if you have to travel to a different place and you need to be there 3 days, but your activities, let's say you tour properties, only cost you 2 hours, and then you have meeting a couple people on different days. How many hours will you count for that trip? 48 hours, or is that just the time that you doing the property?
Yeah, I would do the time that you're touring the property. If you had like travel time like between properties, I would include that, but I wouldn't include your flight time or drive time to get there. But once you're there working, going between properties, or like even if I've done this, like driving through a neighborhood. We were in Miami, Florida a couple weeks ago. I'm like, let's go see if we'd want to invest here. We're driving these neighborhoods, we're calling agents, looking at different deals. That time I would log all that time over there, but not like travel time across the country, because we're not really doing like what the IRS cares about is if it could really qualify as real estate related activities. And like, yeah, it was in a plane, that likely wouldn't count.
Hey, quick question, Brent.
Yeah, go ahead.
So getting back to your example about the depreciation. So on the $250,000 asset, if you're a GP with a 10% stake, it would behoove you then to take it, the 7,500 depreciation against your income. So say you operated with a $7,500 profit, you would take that whole $7,500 depreciation, and then you would have no taxes on that property, correct?
That's right. Yep.
Fantastic.
That's exactly right. Yeah, I didn't finish that side of the example. Yeah, the GP would have a loss, and if they earned income from that, or if they're a real estate professional and have income from other sources, it would all flow up to them personally, and they could offset it there.
Great, thank you.
Yeah, you're welcome.
Got it. Okay, that's great. Thank you, Brent. And again, guys, I want to make sure that how long more is your presentation, Brent? Because I'm sure people have questions. I see some hands already.
Oh yeah, as Martina would tell you, I never have a specific time of presentations. We could keep going, or I could stop anytime. I love to be flexible.
Man, we just want to be really respectful of your time and everything, right? So yeah, I mean, keep going. Make sure that you guys save your questions there, So I'm sure like we'll take them all. We promise, right? Brent just say that, right? So
Yeah,
keep going,
yeah,
Brent.
we'll take all your questions. So really, the last thing to like get it, well, not well, it kind of is to get around the limitations of the passive loss rules. Like I would say these are the 5 main things. That bottom one, the short-term rental loophole. If you, and this, it's usually not a raised or syndicated deal for the short-term rental loophole, but if you go buy a property on your own, or you and your spouse, and you're operating a short-term rental, that can be treated more like a hotel, like an operating business. And the tax laws are different with that. And it's not passive by nature. It's like an operating business by nature. Oh no, I've got one more before we jump into other questions. The other way around it is if you are married, you could have your spouse as a real estate professional. So I've consulted with a few clients. This is probably five or six, where after consulting with them for a year or so, either husband or wife or spouse, one of them decides to quit their job, and they say, you've explained the tax benefits of one of us being a real estate professional. I'm quitting and we're going to focus on, or one of them is going to maintain their full-time job and the other one quits and becomes a real estate professional. Because if the spouse is a real estate professional, those passive losses to the spouse can offset the other spouse's W-2 earned income. So it's pretty amazing. And like, yeah, it's very amazing. But
so who won this call? Which one of you ladies wants to get married? But I'm the one quitting. I'm just playing. I had to do it, man. I had to do it.
Oh yeah, that's funny. Hey, let's do you guys want me to go through? I can go through the chat. I've got it open now. Do you want me to just go through some of the questions on the chat and just kind of jump through some of
Sure.
those?
We can do
Okay.
that. And if you're enjoying this, guys, put some fire in the chat. I see a lot of people in here active tonight. If you're enjoying what Brent's saying, let's put some fires in the chat. Let's show Brent some love,
Love
some
it.
claps.
Love it, guys. Okay, let's scrolling down. And if I missed your question, I'm scrolling. I'm trying to make sure to see all the questions. Okay, Jake, we got your question there. And we got Corey's about the depreciation only going against passive income streams. Yep, it continues to roll over year to year. Actually, I'll just kind of bring that onto the screen. There we go. Okay, Luis, can that depreciation go against my W-2 income in the case of those who are not real estate investors full time? And the answer is no, unless one of these five things applies. But I will tell you if you are active in real estate, and there's all sorts of different rules, but if you're somewhat involved in real estate and if you're not meeting the 750 hours, if your income is less than $100,000 or $150,000 if you're married filing joint, there could be some passive loss deductions that you can take from real estate. And it has that income threshold. But if you had a $67,000 loss and $100,000 of income, the max on that, it's $25,000 is how much you can take on real estate when your income is less than that $100,000. Okay. And this question, Mark, you had asked like how far in the future. I was probably talking about something specific, but if you wanted to clarify on your question there, I could answer that about the future. Okay, then Juan Carlos, you mentioned how do you know if you are on the 27.5 year or the 5 year? And this right here, so let me go back to, we'll go to this one. I'll clean this up a little. So remember this diagram here that I covered, these other assets here that are eligible for bonus depreciation. These are 15-year assets, 7-year assets, and 5-year assets. And really determining which one, like which category you're in or which category the assets are in, building, land, or all these other categories, that's the official process of a cost segregation. That's the part that gets hired out. Like we do them through my CPA firm, or there's some CPA firms do it, or there's cost segregation companies that do specifically like cost segregations. And that's the formal process of breaking down the assets. So instead of having like building and land as your assets on your depreciation schedule, you'll have like 30 different assets on your depreciation schedule. Okay. And then, so if you sell the property, great question. So Renee had a question, said, if you sell the property, wouldn't that be capital gains? And remember the part, I think this is when I was talking about, what number is this right there? Number 3, when you sell the property, we can release those losses. There are likely going to be capital gains when you sell it. Like that's the hope, right? We want to have capital gains when we sell it. We want it to go up in value. The losses that have accumulated will be released in that year, but you might also have a capital gain. So you're getting a deduction from the passive losses that carried over, but you might also have a brand new capital gain that hopefully you were planning for, but you'll report both of those in that year. Unless, of course, you do a 1031 exchange and get into another property. But it's, very good. You don't want to forget about the potential capital gain. Okay. And Julia, how would you track this? And when it gets audited in tax season? I think we did cover that, about keeping that log. And thank you, Yoshi, for the updates there. Yep. Renee, we covered your question there. All right. Would you be able to use, from Jen, the depreciation loss from one property to offset the capital gain from selling another property? And the answer is yes. Like you'd have passive income, passive losses, you'd be able to offset that. And then Lena, so I'm assuming real estate conferences count. That's I think Yoshi said I was saying yes, but I think my answer is a maybe. It'd be maybe. Like if you're using that, like if you can really apply that, you're like, hey, I'm here for a specific deal. If you can link it to a deal, I'd say yes. How do you prove your hours? That's the log we talked about. And it's the IRS, a lot of times, like in an audit, and like while they are rare, but in an audit, if you ever were audited, they're going to make sure you're being reasonable. Like they're going to check to see if you're reasonable, like if you can be a trustworthy person. If you're like, oh yeah, I called a plumber to fix a leak at this apartment building. And if you logged 8 hours for calling a plumber, they'd be like, we don't trust your math. if you're logging 8 hours for that, we don't trust your math. So just make sure your log has sufficient detail and just that it's reasonable, like the hours match like the work done. And then does travel 4 hours at real estate conferences count? I think we covered that. If you're a GP, are your gains then considered active income and cannot offset your income with passive losses? If you're a GP, you would have, I'm assuming you'd be a real estate professional, and you can lump all your activities together. So even if some were active and some were non-passive, they could all be lumped together as a real estate professional. Okay. Yeah, and there's a website there, REPS, Real Estate Professional Status Tracker. There's going to be companies, and there are some apps there that will do it as well. They might even have an app, but yeah, if the options I mentioned don't work, if there's something that's like there to just remind you constantly, I would recommend using something like that. Okay, so yeah, then Renee has a question. If you're a licensed real estate agent, you automatically qualify to offset any of your income against the passive loss. And you don't automatically qualify. Like if you're a real estate agent, like it might seem like it because you're like, yeah, the IRS wording is real estate professional and you're a real estate professional, but it really comes down to the hours. It makes it much more reasonable, in my opinion, if you're a real estate agent to have real estate with passive losses offsetting your income. Like it would be very reasonable, I think, to prove to the IRS, like, yeah, real estate income, real estate losses, they should offset it. So I think I'd still track your hours just in case, but I don't think you'd have a hard time with that. And to actually go along with that, if you're a real estate agent, all of those hours of buying and selling other people's homes, those count. Those count towards your real estate professional status. It doesn't have to be like 750 hours like working on your real estate deals. It can be all real estate related things. So I have a client, he's a land surveyor, and he had an S corporation and he had a partnership with some investment rental properties, and he was not treating himself as a real estate professional. I'm like, you survey land for a living like this. You are a real estate professional. So I had to drill that in his head 3 times. I had to tell him he was a real estate professional. All of his hours doing the land surveys counted. Let's see. How can I offset my hard-earned money in my construction business? Oh, that's perfect. Luis, you are a real estate professional. You build houses for a living, or you work on houses or repair houses. That you would count as your, like, as long as you own your business, you would count as a real estate professional. So that's a perfect scenario. Have someone with a profession, self-employed person, like with a business, and they are having a business in real estate. That is a perfect scenario. Okay. Yep. Yeah. 14 hours a week. That's good. Yeah. Not a lot if you're doing it full time. Yep. We can offset the capital gains from those properties with the passive losses. Let's see. Yeah. Sergio's getting married. Who's Sergio getting married to? So he can, he'll volunteer to be quit and be the real estate professional. Love it. Okay, let's see if we got any other questions there. Oh, we got 20 more comments. Okay, Corey asked, can you clarify number 3? Did you say you can take the depreciation at disposition, or do you mean it goes against capital gains? We take that, so that depreciation, it becomes like, so it starts off as depreciation. Here's like the life cycle of a real estate loss. Starts off as depreciation. It goes over to be a passive loss. At that point, when it becomes a passive loss, it's no longer depreciation. It's just an accumulated passive loss that carries forward year after year. And when you sell that property, it becomes a non-passive loss that can offset any other income. So you'd have that year, if you had like W-2 income or like other work income, that carried over depreciation, that was the carryover loss, that will reduce that income that's taxed at a higher rate. So if you asked me, would you rather pay tax on W-2 income or capital gains? You'll always I would rather pay tax on a capital gain because W-2 income is taxed at a higher rate. But that carryover loss will offset other income first. And if you run out of other income to offset, then it can be used to offset capital gains. Hopefully that makes sense. Okay. And then, so Mark was asking how many years it rolls over. And so this is that passive loss that's rolling over. And that's correct. It does roll over indefinitely. So remember, going back to this LP that had a $67,000 loss, if he or she never has these other things that would qualify for that loss to be released, it just carries over indefinitely till it can be used. And maybe they'll change the tax law on it 1 year and we can release it all in 1 year. Who knows? Okay. Let's see. Yeah, I missed the first 15 minutes. The LLC that pays the LP in an S Corp. Nope. And that LP in this example is not an S corporation. And I did put an S at the end of there, so that might have been confusing. I meant LPs, like multiple limited partners, but yeah, not an S corporation. Okay. And I want to make sure to get through everyone's questions.
I'm sorry to butt in. I'm
No,
about
go ahead.
to get on a flight, but I have a note here that says S Corp manages the LLC and the LLC pays S Corp as a management fee. I don't know why I wrote that. Can you help me with that?
Did you write it today, or is that just from the past?
Yeah, it was over the weekend.
Yeah.
So, yeah, it might be out of content. So
no, there's so let me share with you guys real quick, and I'll get to those other questions in just a second.
Okay.
But if you were like, if I was consulting with you one-on-one, and with most people, I have a commonly recommended structure that we recommend at the CPA firm that I've started to do myself, or years ago started to do myself. I call it the Bement blueprint, just to have a catchy name for it. But if you were to have, and I'm tying this into your comment here just a second with an S corporation, but this Bement blueprint would look something like this. You'd have an S corporation, and it would start off as an LLC. That's usually the easiest way to do it. Then over here, you'd have your LLC. And let's just say you own 100% of both of those. So that's you, whoever listening to this. You have an S corporation. I call this the operating company. This might help if you're listening to any of my podcasts or listening to anything else. That's your operating co. And over here, this is your investment co. Investment co. I'll commonly call this the holding company, even though a holding company is really just any company that owns other businesses. But if you have, so right here.
Are you white?
What was that?
Are you whiteboarding this? Because I still see the passive income and the 6 items.
Oh.
Is it just my screen?
It might just be your screen. Yeah, I've got an
it.
updated one. But hopefully in the recording, it shows what I'm drawing now, even though you might not be able to read my handwriting here.
Okay.
Okay, so look at this. So this is the blueprint I recommend. So you have,
Try refresh though.
yeah.
Yeah.
So you have a property LLC, like that LLC, its sole reason is to own a property. So you got that. Your investment holding company is right there. That owns other LLCs. If you're doing a syndicate, or if you were investing as a part owner of a syndication, that LLC could go own, let's say you just own 1% of another LLC. That could be still under your structure, but you don't own 100% of that. You'd be an LP and you could have, say, like the other LPs and GPs would be over there as this other 99% ownership. But I just want you to see that. So now getting to your question of, does it make sense to have like an S corporation receive a management fee from one of your other entities? If that was your question, that you, maybe it was divine intervention, maybe you wrote it in your sleep, and that's how important the question is. I hope this will help with that though. So your property LLC could pay over here a property management fee for managing this property right here. So it's like, you might think like, why would I do that? Because if I'm sending money from that LLC over to my S corporation, in the end, it's all coming up to you anyways, right? So it might seem like there's no tax impact. In the end, for taxes, it's going to be the same. Like if you own both of them, there's not going to be a tax benefit there. But the reason why I would recommend people would do that. And again, I'm not an attorney, but I'll give recommendations based on, or I'll give you explanations based on recommendations I've heard attorneys give. And they would do that for asset protection. So if there's a lawsuit here with that property, and say you go and sue, like they're mad at the property manager didn't do something or inform them of something, or left a wet spot on the floor and they fall and break their arm. They go and try to sue the property management company. The property management company doesn't own the property. So you go, all right, I lose the lawsuit. I close my S corp, I'll dissolve it, and I'll just go bankrupt on that S corporation. So keeping your, like whenever there's services provided, or like you're selling goods or you're providing services, that's on that operating. Like if you think of like operations, like earning your income, that would go into your S corporation, compared to owning the asset, like having valuable things owned, that's going to go on the investment side. And sending money back and forth or having a contract with your S corporation, the main reason for that would be to transfer liability over to the S corporation. And that's when I'd say, like, have an attorney review your property management agreement, have them review like your lease agreements with your tenants. That's when it's going to get really important. If there was ever a lawsuit, having that structure set up that way would protect you. So just remember that operating company, S corp, investment company, is the holding company. And when you do it that way, you can add additional tiers below that. If you want to go partner with a friend on something, never give up ownership of these entities right here. I know I've got all sorts of chicken scratch, but never give them your S corporation, never give them your investment holding company. You can create a new entity underneath that, and you guys can share ownership of that new entity that's a sub entity.
Thank you. I remember the topic was about asset protection. So
sweet. So that was the answer, right?
Okay. Yeah. Because they had multiple companies, and they're talking about how they come sue one, how exactly what you said, that they couldn't come after all the other companies. So,
Awesome.
all right.
Hey, Brent, quick
Can I ask a question? Because I know there
Go
are.
ahead, let it go.
Yeah, go ahead.
So there are a couple of us on here that are raising for a fund, and I wanted to see if you had any. I mean, is that something that you can easily cover with respect to, like, if I'm seeking investors $100,000 in a fund,
versus into a syndication? How does the bonus depreciation work?
Yeah, the tax law will be pretty similar. So when the money goes into the fund, so you'll people you're raising funds from, them putting the 100 grand into the fund, that's not what creates the deduction for them. It's what the fund does with the money. So if you leverage their 100 grand and go buy the $400,000 property, the depreciation, however, that would be allocated based on the ownership percentage. And there's in your fund, if you're starting a fund or raising for a fund, you've reviewed some operating agreements and you know how complex they can get, and say, okay, well, the investors get the loss allocations and everyone gets the gain allocations. It really comes down to that. But from a tax perspective, we kind of just interpret the operating agreement and we can do those same or very similar allocations as if it was just a syndicated raised deal for one property.
Okay, so if I'm understanding this correctly, if you're investing in a fund for a particular property, the previous investors in the fund don't get the K1s, or do they?
That's where that will all come down to the operating agreement so it could be either or. Like you could write the operating agreement to say new investors after this date are getting the losses allocated from this specific deal. Or it's a shared allocation, like it's all pooled together and just allocated just based on the new allocated percentages for everybody. Or you could say you could kind of do two different tax returns. You say, okay, the first 10 investors in the fund from January to October, that's what the activity was for 10 months. You can calculate it and say, okay, they're getting a K1 with this amount. But then you go, well, we brought on 2 new investors and they shared in only the October through December activity. And so for those 3 months, and you could allocate the depreciation that happened in those 3 months and it could be those 3, or it could be all 13 investors.
Yeah, so we need to verify that with the fund managers or whoever's in charge of the fund then.
Yeah.
Thank you. That's very helpful. Appreciate it.
Yep. You're welcome. Okay. Let's see. Is any of this impacted with the BOI, the beneficial ownership information reporting? And yes, you have until the end of this year to fill out those forms, to file them online or have someone file them for you. But in this example here, I know I've kind of ruined it now with all the drawing, but that S corporation, that LLC, the sub LLC, all those different entities, they all need to file a beneficial ownership information form. And you got to, anyone that owns more than 25% ownership, you got to add their birthday and social and address. It all needs to get added on there. But then remember, if you formed a new LLC in 2024, you have, they just changed it. I'm going to say 30 days. You have 30 days to fill out the BOI form for the new ones. Existing ones you have till the end of the year, but for a new one, you have 30 days. They might have changed it to 90 recently, but to be safe, I'll say you got 30 days to fill it out. So if you file a new LLC, if you create a new LLC or have it created, I would just have the BOI filing, just do it part of that same process, like state registration, IRS registration, file the BOI. Okay, awesome. I think we're getting to the end. So yeah, one question about a K1, and I know I throw that word around all the time, but a K1 it's your portion. It represents like your portion of the income or the expenses of your ownership in a partnership. So if you're an investor and you give 100 grand into a syndicated deal and you end up being a 10% owner, the K1 that goes to you, it's like that property will file a tax return. It reports all the income expenses, does the depreciation, and then it'll give you a K1, just a couple pages typically, saying, hey, you're a 10% owner. Here's the net income. Here's the depreciation you can use. You'll take that K1 and you need that to file your personal tax return. So the K1 is the year-end tax reporting document for your ownership in that partnership.
Awesome.
Hey.
Thank you so much for that. We have Corey on the chat that asked, what was the max write-off you mentioned before? It was based on income, active, passive, or total income.
Let's see. So yeah, the max write-off, I think that was probably the $25,000 max deduction I had mentioned when you have passive income. So there's the first limit. So say you're a single filer, you can have up to $100,000 of income from, like, say your W-2 or all sources. You can have $100,000 of income there, like of all income that's on your tax return. That's typically going to be your active income. And then if you have passive losses coming into you on a K1, you can use up to $25,000 to offset your active income. I know it's a pretty complex part of the tax law, but the 100,000 was your earned or your active income. The $25,000 limit is the passive loss that you can use to offset some of that income.
Great question. And hey, Brent, I got a I'm probably one of the last questions on here,
Okay.
but I will, unless anybody has any more, but I think you kind of went through them, but I have a very extremely important question that everybody has to know, just because today's episode was guys, we do this every Tuesday so that you get to learn something, right? We want to educate the public. We want to educate everybody as much as we can, bring in all this value. And tonight was obviously an episode of bringing a professional CPA who does this, right, in and day out, and even on a personal level. Brent, my question to you is, this last Thursday, we actually we have monthly meetups in Dallas, Texas, right? We had a special guest who was a cost segregation expert who touched base on a lot of the cost seg and how is it that works. And we had a lot of investors that were new to our community that came into our meetup that Thursday, right? A lot of one investor specifically came on and he was just mind blown of the depreciation of the cost seg. And my question to you is that for an investor to be educated, they got to ask the question. It's obviously good to know how is it that this works, to be able to ask the operator, hey, listen, Mr. Sponsor, Mr. Operator, are you guys doing a cost seg? Are you guys taking advantage of depreciation? Now, my question is it important to really start asking these type of questions to operators, because not everybody does them?
I would, yeah. Especially like in your year-end tax planning. Well, I'd be doing your tax planning year-round, but especially those 3 months before the year ends, you're going to want to know like roughly what your deductions are going to be. And especially if you're a real estate professional, it'll directly impact your taxable income. I'd be asking those operators and GPs and say, hey, what are your estimates for the deductions for each of the LPs? Like it should be top of mind. It should be something that they've considered before, and they should be able to give you some sort of estimate on it.
And the reason I say that is because a lot of the times people invest in the multifamily we know a lot of people that are just, they have a tax problem. So they're looking for that depreciation. So that's why they come. And a lot of the times, some newer investors don't know. They're just like, oh, okay, well, here's the money. And they don't know what questions to ask. So that's why I kind of wanted to play devil's advocate there.
Yeah.
And to just kind of maybe give some tips on, to some of the people in this room who are fairly new that are investing in these deals, maybe some 2 to 3 questions on what to ask operators when it comes down to this kind of stuff.
And it's hard. So actually why I started the podcast in the Wealth Game podcast in the first place was like, I'd get on a one-on-one consultation with clients, and like a lot of times they didn't know which questions to ask. Like I try to ask about their goals and what they're trying to do, what taxable income they need to offset, but it's hard to cover everything. Like in a 1-hour call, we can't cover everything. So I'm like, I'm going to create something to just keep giving ideas out there, and it might spark something in their mind to be like, oh, I need to look into that, or that might apply to me. And that's helped a lot with people. They're like, hey, I listened to this episode. That actually does apply to me. Or I'm going to have my wife quit her job So she can be a real estate professional, just a way to get more of that information out there. Because so I do have the podcast, and I do have a group. If you go to that wealthgame.io website, I've got a free collection of some videos I've done called the Wealth Game Basics. That's not the group training, but the group training is the Wealth Game Alliance. But I would recommend go to the Wealth Game Basics, watch those videos. I'll cover more of what we've covered here, kind of some like specific tax saving strategies, some specifically for real estate investors. And if you're like, okay, now I want to know, or I want to dig into this or that. And if my scheduling it like fills up pretty quick or a few weeks out, and it's expensive to meet with me one-on-one, but if you're like, I just want to get on the group and just start asking questions there, you can join the Wealth Game Alliance calls as well. We got one tomorrow, actually. Tomorrow at 11 a.m. Mountain Time, if anyone wants to join. Yeah, and there's the podcast. Yoshi just shared it. The Apple link. So there, or if you just search, I think it's on every main podcast site. You can search it there too. But at minimum, go just look through the different episodes. And it's for people like me that are a little impatient and you're short on time and you don't have time to listen to an hour or two long podcast. You just want to get to the point. That's how I've structured these. I'm like, I'm just going to jump right in. I don't have any guests. It's just me kind of going over some of these strategies. You can look at 1031 exchanges or cost segregations and just kind of hear another way of me explaining it. And it might be what clicks, like what helps you really understand it. Because this stuff is like from the outside, and when you're first getting into it, it just seems insane. Like I've told you, the tax law is weird. It just seems crazy. There's so many entity structures, but the more you get into it, it just starts clicking and stuff just falls into place. And it just feels normal, or just gets normal and simple. Like once you get to that point, but I do understand like getting that point of understanding, like it just feels like it's all over the place. But once you get the education, it'll just start making sense. Then Luis, can you be my CPA? I need a really good one. I'm in Virginia. Yes, we have some clients in Virginia. I think we've got clients in probably most of the 50 states. We've got 12 employees, and we've got some part-time employees and part-time bookkeepers as well through the CPA firm. We're headquartered in Utah, but we've got employees in a couple different states.
There you go, Luis. Looks like you got yourself a new client from this call, Brent, so it was well worth it.
You guys are awesome. Yeah, you guys, this call was awesome. You guys had great questions, and I love the group. Like what you guys are doing, Sergio and Yoshi and John, everyone involved, you guys are doing some awesome stuff, because 2024 is going to be a great year for real estate. And
I appreciate the nice words. And just to kind of wrap it up, one more question, just because I know we were kind of just taking advantage of multifamily and all that. We also do manage a real estate fund where we basically help people also invest into fix and flips. Now, my question to you is that something that we're still able to take advantage of when it comes to managing that kind of fund into the fix and flips?
Yeah. So all that would still apply. Like the tax law, what's been working in the past few years, really since 2018 is when a lot of it shifted. 2023, 24, 25, you're going to have the same opportunities, the same tax advantages and same opportunities.
Nice. It looks like we're going to be calling you. Yoshi says she's going to call you. Julia Castro asked, what about Washington State? Hey, you heard Brent, he's everywhere. He's all over.
We got clients in Washington. Yeah, it's all Zoom. If you're fine with Zoom calls and DocuSigns and digital, we went digital about 10 years ago. So awesome. Yeah, we love it.
Well, Brent, we really do appreciate your time. Once again, thank you so much. And if everybody just enjoyed tonight, y'all don't forget to show him some love. Subscribe to his podcast. Book an appointment with him. He is not cheap, but he is really, really good. But hey, well worth it. So that being said, Brent, thank you so much. And we do really, really appreciate you, man. And I hope you had a good time.